One of our top traders developed a strong thesis around the direction that he thought Amazon was headed in the short term and decided to express that trade using weekly options that expired in 2 weeks. I'm Seth Freiberg, the head trader of SMB Capital's options trading desk here in Manhattan, and the traders on our desk have a full understanding of how to use options to swing trade ideas that both enhance the return potential of those trades and at the same time cut the risk if they're wrong. So if you're interested in how pro traders use weekly options to capitalize on swing trading opportunities on volatile stocks, then stick around because I'm pretty sure you're going to find this intriguing. Hi, I'm Seth Freiberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so as you probably know, Amazon is a stock that's heavily traded by day and swing traders, and that's true at our prop firm as well. But what might not be as well known is the fact that prop traders often use options in lieu of using shares to express their trading ideas in order to limit the downside risk of that trade on volatile stocks, while at the same time substantially increasing the returns on those same trades if successful, because options can double, triple, or even quadruple, and even more very quickly as compared to trading the shares themselves, as you're about to see. Now, in this case, our trader bought what are known as call options in order to capitalize on what he thought was a setup for a bullish move on Amazon. And so we want to make sure that everyone watching this video understands how call options work on stocks. So we're going to do a really quick review, and this is going to be quick. So those of you who understand call options, just hang in there, and we'll be back to how this trade played out in a minute. Okay, so what's known as a call option on a stock entitles the buyer of that option to buy 100 shares of a stock at a certain price called the strike price of that call option, regardless of what price the stock is actually trading at when he exercises that right. The buyer of the call option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go way above the strike price of that call option, in which case the buyer can exercise his option and force the call seller to sell his shares at the call's option's strike price, which is lower than where the market is trading, causing the seller's account to get marked down. So even if the market goes way above the strike price of the call option, the buyer of that call option has the right to buy 100 shares of that stock at the strike price of the call option, and he can turn around and sell those shares at that much higher market price 1 second later for a big profit, theoretically. And so the premium of the call option reflects the risk that the market thinks the call seller has of the shares going much higher than the strike price of that call. So all other things being equal, when a stock price goes up, the price of a call option for that stock will also go up because the call seller's chances of taking a loss because the market has blown through the strike price of the option gets larger as the stock price rallies. So in this video, Max is going to be talking about buying call options on Amazon stock, and those calls are expiring 2 weeks later. So for example, he talks about buying call options with a strike price of $3,700 on Amazon for an average price of $7.07. So let's break down what he means by that. In this example, Max buys 80 calls on Amazon for that price. Well, $7.70 is the price of the option, and a call option provides you the right to buy 100 shares at the strike price. So you multiply that by 100, and you're buying 80 of those. So that would have cost Max a total of $56,560. Now, before we move on to Max's explanation of how he uses call options to capitalize on his thesis that Amazon was about to break out to new all-time highs, I'd like to let you know that if you would like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, plus the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on the direction, then click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. All right, so Max, why don't you run us through this Amazon options trade?
Absolutely. So at this date, Amazon was in approximately a $300 range for the last year. Over the last week, there was approximately, I think it was maybe 3-4 days where there was just a bull flag, that was just like forming. Basically, it was against 35.25, and all-time highs was around 35.45-ish. And I think it was maybe 3 days before this, Amazon fell, built up a base, and then there was a strong volume day into the weekend where it was going from around 34.40-ish up to around 35.10. So what this told me, especially with the fact that the market looked quite solid, was that if the market were to then gap up, and the ATR on Amazon is approximately 40 or 50, Amazon should therefore break that 35.25 resistance and then go straight basically to all-time highs. In doing this, that sort of a volume move would therefore probably lead to a IV explosion, because now the range is expected to expand, and also the fact that it's making new all-time highs should now bring in demand for buying calls, as people are going to speculate that Amazon is going to now break out and move from this range that was pretty well telegraphed.
Why don't we explain, take a minute to explain for the folks watching the video that when Max is referring to an IV explosion, he means an implied volatility explosion, which basically means the options market will suddenly anticipate a larger move than it had previously. That if Max's thesis is right, the options will basically become pumped up with price, because the option sellers have to protect themselves against the possibility of a much larger move than was previously anticipated. So if you're long one of those options before the implied volatility gets pumped into them, that's a good thing for you.
Yes. So like for this trade, as Amazon breaks out, by just like the nature of being long out of the money calls, I'm naturally just being long more stock, because the delta is appreciating. So for example, if let's say I was long a 0.2 delta, it means that for every 100 shares of option, or just like one contract, I'm long actually 20 shares. Right. If we now get to the strike price and that delta gets to a 0.5, that 20 from that point on is now 0.5, and therefore I'm long 50 shares. And also as the IV goes up, that's also very beneficial as well.
Right.
So just kind of looking at the actual picture here, you can clearly see it was in a consolidation around a 300-point range or so for the last year. And if we just kind of zoom in on the last few weeks, you can see it basically dropped out from that 35.25, came into around 34.40-ish where it based, and then that one big day on strong volume, you can see went from 34.40 up to 35.10. So like one signal like for me here was that there was a strong overall volume day into resistance, which basically led to a risk-reward trade of either that was a sign that it was just going to break out and then a gap and go, or it would fail. And that's why I wanted to use options instead of being long stock, because if I was long stock and it failed, once again, it probably would have just like faded back off, and there would probably be a decent amount of risk there, whereas with the options, it's only premium paid. So as far as the actual trade, I bought the 3,700 calls between 525 and 8. The average price was $7.
And according to this, just building on this delta point that you made a couple minutes ago, Max, I looked this up, and you were at a delta of 11 on the options that you bought.
Yeah.
So that's sort of the equivalent of, per option, owning 11 shares of Amazon.
Correct. So it was definitely a speculative trade. My plan was that because I expected on Monday for this to do that gap and go, I figured that if it didn't do that, or let's say there was like no gap, or it would have gapped down, or just been flat, then I would sell it, right? So in trying to figure out the risk for the trade, I figured out what was 1 day of time decay, which by looking at the theta for the trade, I was able to do. And then like the rest is just deltas, which would just be like the same thing as being long that amount of stock. So for example, if let's say I bought 80 of them, if I was long 1,000 shares, that would basically be like the same risk from a stock point of view. And then like the extra risk is the theta, but obviously if Amazon went to like down $200 for some reason, then like the risk is only premium paid. And given like these factors, it just like made sense, for it to be out of the money. It didn't really make sense for it to be at the money, because I thought that one thing that would make this trade special was that if it broke out, the IV would have exploded, right? So therefore, it doesn't really make sense for me to be at the money, because it wouldn't really appreciate as much for the at the money calls, whereas out of the money calls will actually see that IV explosion factor in more, because at let's say up 200 points, those like 35 20 calls are so deep, in the money, that it doesn't really then like matter what the IV is, because almost all the value there is just going to be based on where the stock is, rather than the just like other factors like IV and time and stuff like that. So on the opening drive on Monday, I sold maybe 60% of these calls, and the point was that on this first move up, I was locking in risk in case it was a failed breakout, but we also saw the fact that on this move, IV exploded, so I'm locking in some of the actual stock move, but also the IV as well, and therefore, like from that point on, I'm more relaxed because I know that my risk is therefore covered, and I then just scaled out on an ATR basis. So Amazon was around 34 or 35.80, and then I think that I was scaling out to around 36.50-ish. ATR was 40 or 50, basically just kind of scaling out into that move. And then at that point, because the IV expanded so much, it didn't really then like make sense for me to keep on the same trade, because part of being in the options was a IV thesis, right? So it played out. At that point, I want to have some more, flexibility. So if let's say I had 10 of these that were left over, delta is 0.3, let's say, on them, right? At around like 36.50. So that means that instead of being long that, I switched over to, let's say, being long 300 shares, and that was the leftover. In terms of actual delta on the close, it was the same, but there was no IV decay or stuff like that.
Right, that you have to worry about, because the move, you don't know if the move's over or not, right? And then you're going to lose your premium value very quickly. If the market starts to think this is settled, a lot of that IV is going to come out of those options.
Absolutely, yeah. So if there was a inside day, then it's possible that IV would have just collapsed once again.
Exactly. Just one point, that the next trading day was actually July 6th, because that was July 4th weekend. So I think that Monday was a holiday.
Yes.
So your next trading day was July 6th. That's the day where you took the whole trade off, and you locked in all your profit and you locked in a profit as soon as you sold 50 of those 80. But the remaining 30 that you had, the delta on those was 21. So you had a 10-point increase in delta. That's almost like doubling the number of shares you had proportionately per option. So you walked into a really big increase to start with. And then by the end of the day, as you scaled out of everything, the delta had gotten to 29. So now you had almost essentially tripled your share equivalents of for each at each option level. So it was a great trade.
Thank you. Yeah. So like I mean, even just like being like long like 30 there, I was basically like you said, just I think long 30 at a 0.2 delta is still like 600 shares.
Right. Exactly.
And I was in like maybe 700 by the close before then.
Almost 900.
Oh, okay. Yeah. So I mean, It was still overall quite long. Yeah. So this just kind of illustrates the first part of the day. You can clearly see that like the volume was in there. And then yeah. So I mean, at this point, I think the fact that it was like basing over all-time high, it told me that this still should overall trend, so that so therefore I should be a little bit more, just like slowly, just like scaling out this trade. One thing that I did do was that when it did kind of just like dip down and like from like 36.40 back down to like 36.10, that was like the first like real pullback there. So one risk was that if that was highs and then it just flatlined for the close, IV like would have then fallen. It was still around like 75 points out of the money, so it's not like there wouldn't be like no just like loss there. So on the first sign of a potential failure, that's kind of when I go into more like risk off mode. Final sales probably 36 like 70s. I kind of forget exactly, but it was approximately there. And then yeah, I mean overall I'm very pleased. I think that the one error was not doing the July 9th one, so basically that like same week, because like the plan was to sell on Monday or it was Tuesday. So I could have just bought like less premium, bought maybe instead of the 3700s, I think at the point like one delta for the following week was probably, let's say 3630s-ish, and therefore it probably overall would have made more. I think that my logic was that if, let's say, there was a slight gap and then it grinded through highs, because it was like 9 days out, there would be less theta then. So I was kind of just going through that scenario. At the same time, though, it would have probably been smarter maybe to just like split it up, because if I did like July 9th at this point where it was at 36.40, my delta would have been 0.5 or 0.6 even, instead of being only 0.3, and therefore all the profit from that point on would have been like that much greater. Right. So like definitely like something that I'll think about for next time.
Yeah, I mean there was a slight disconnect between your thesis and the options you bought. That's true, but you gave yourself some room for your idea to play out over time. Because if you just did that next week's options, for example, and it actually took 2 weeks for your thesis to actualize, then you're possibly completely screwed, right? Suppose it took a little time, but if your thesis was strongly right after the weekend, there's going to be a big gap up, then that would have been a viable option to have chosen that next week instead of the week after.
Absolutely.
Right.
For sure.
But the other thing that if you go back to the slide with the end of the day, you look at the end of the day, what's the price there?
36.78.
Okay, 36.78, right? You're still 22 points out of the money, right? So people who are sort of new to options may not fully understand that if this was expiration day, that option at the end of the day would have been worth zero.
Yeah.
Instead of the price you got for it during the was an average of, I think, $47, something like that, as you were scaling out of it. But if that had been the end of the day and it was expiration day, it would have been zero. So if it had been a little bit of a different scenario, you would have lost your entire investment with the same price movement. Yeah. But because this option was expiring 2 weeks out, the option appreciates because the market's looking at 36.78 and saying, holy crap, this could go, suppose this goes to 3,800. We've got to price in these calls heavily because this thing is really taken off. We don't know where it's going to stop, and we got to put some heavy pricing into this to protect ourselves. That's the way the seller of the option's looking at it, and you get the advantage of that. So the fact that you were so far out was a big part of why those calls appreciated so much.
Absolutely.
Yeah. So it was a really terrific trade, and what I loved about it was how you, first thing in the morning, ended your risk. So now you're in the driver's seat, right?
Yeah.
Now you can play it the way you want to. And you know that you've got a certain amount of profit locked into this trade no matter what happens. And you can then be, in a sense, more relaxed, and you're probably trading a little bit better because you have no risk left on the trade. It's like you have 30 free options at this point, right?
Yeah.
To play with. So
Worked out well.
they were lottery tickets.
Yeah.
Great trade.
Thank you.
Now, one point I'd like to focus on is how quickly Max turned this into a risk-free trade so that he had the luxury of the rest of the day to take advantage of even higher prices as Amazon continued to push upward during the day. So let's drill down on what he was saying here. Remember how Max talked about buying those original 80 calls, expecting Amazon to rally to new all-time highs when he entered the trade initially. So those calls cost on average $7.70. And remember, we multiply each put by 100 for the 100 shares they represent, and he bought 80 of them hypothetically. So that would come to a total cost of $56,560 in the first phase of the trade. Then in the second phase, he took all of the risk off the table by selling 50 of those calls on the opening drive for an average price of $18.39, which, as you can see from the calculation, brought in $73,560. So at this point, this was literally a no-risk trade because he had sold 50 of his 80 calls for $17,000 more than he paid for them, and so he now basically owns 30 free calls that he could have cashed in at any moment, but his trading instincts told him to hold on to those for greater value as the day goes on. And if that greater value never materialized, he could have held them for the next day or sold them at a lower price or even ultimately allowed them to expire worthless while still walking away with a minimum of $17,000. So he was in the driver's seat at this point. And then, as we saw, Amazon continued to rally during the day, and those calls became even more valuable as the day went on. So in phase 3, throughout the day, Max continued to cash those calls in, but this time for a greater and greater value, such that the average price was $47.39 on those call options that he slowly cashed in during the day, which comes to, on average, more than 6 times what he paid for them, while being completely free of risk during the whole process of further enhancing his profit by over $142,000 by the end of the day. So to summarize, as you can see, taking into consideration what he made on the opening drive, taking all the risk out of the trade, and the subsequent slow, deliberate sale of the rest of his position as the day proceeded, and subtracting out the original cost of the calls, his ultimate profit would have been over $159,000, purely focusing on how Max traded those 3,700 calls. And so what I'd like you to take away from today's video is the fact that day traders have many tools at their disposal, and one of those is to use options to take advantage of potential short-term moves on volatile stocks like Amazon without taking a lot of risk through buying relatively inexpensive options. And then if the trade goes their way, they have the option of going into a phase 2, taking all the risk out of the trade by cashing in just enough of the options to guarantee a nice profit while maintaining a healthy amount of calls for further potential gain, with a guaranteed solid floor of profit on the trade either way. Max's strategy is a great idea if you have a solid feel for when stocks are breaking down or breaking out, as the case may be, and you'd like to play the move in a less risky way than outright buying the shares, where you'll have to take on a lot more risk and allocate a lot more capital than you'd need to. A fact which is not lost on top flight professional traders like Max, who have learned to incorporate options trading into their playbook, giving rise to great opportunities like the Amazon trade we've covered in this video. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it.